All right, let's tackle a huge question for anyone with savings in Pakistan. Where should your hard-earned money actually go? We're putting two heavyweights in the ring, the good old savings account versus the world of mutual funds. And I'm telling you, the answer is probably not what you're expecting.
I mean, it seems like a simple question, right? But are you playing it too safe and leaving money on the table? Or maybe you're chasing returns that, well, just aren't there. Let's figure this out.
You know, this whole deep dive was sparked by a real question from a user on Reddit. They kept hearing that mutual funds are always the better choice, but when they looked at the numbers, something felt off. So, just like them, we decided to dig in and see what's really going on.
So here's our game plan. We'll set up the showdown, get to know the two main players, and then we'll hit you with the data that changes everything. From there, we'll look at the bigger picture and wrap it all up with how you can choose the right path for yourself.
Okay, first things first. We are about to challenge some financial advice you've probably heard your entire life. Let's put that conventional wisdom to the test.
You've heard it a million times, right? If you really want your money to grow, you have to get it out of a savings account and into a mutual fund. It's treated like a fact of life. But is it? Now, before we get to the juicy numbers, let's just make sure we're all on the same page. What are these things we're even comparing? Let's do a quick breakdown.
Think of a mutual fund like a big investment potluck. A professional manager gathers money from a whole bunch of people, like you and me, and uses that big pool of cash to buy a whole basket of different things, like stocks or bonds. The idea is to grow the money while spreading out the risk so you're not putting all your eggs in one basket.
So, funds come in a couple of different flavors. You've got your open-ended ones, which are super flexible. You can put money in or take it out pretty much whenever. Then there are closed-ended funds, which are a bit more structured. For our little investigation today, we're really just focusing on those simple, low-risk, open-ended money market funds.
All right, it's time for the main event. Let's pull up the chart that started this whole conversation and see what the numbers from 2024 actually have to say.
Okay, you have to see this, because this is where it gets wild. That first column on the left, that's a high-yield savings account. All the other columns are popular, supposedly higher-earning mutual funds. Now, look at February. The savings account is cruising along at 20.50%. The mutual funds, they're lagging way behind in the 17 and 18% range. Same story in March. This is the complete opposite of what we're told to expect. And even if you look at the total compounded return at the bottom, the savings account is right there in the mix. It even beats some of the funds. This is the data that blew the whole conversation wide open.
So here's the bombshell. That idea that mutual funds always give you better returns? Well, at least based on this data for these specific funds, it's a myth. For short-term savings, a simple savings account was often the top performer.
But wait, is that the end of the story? Is it really just about which one wins in a given month? Not even close. The conversation on Reddit didn't stop there, and neither are we. There's a secret weapon we haven't talked about yet.
And boom, here it is. Another user dropped this absolute gem of a comment. They pointed out that the real magic of mutual funds isn't about the rate this month or next month. It's about what happens over the long haul. It's all about compounding.
So what is this compounding thing? It's basically the snowball effect for your money. Your initial cash earns a profit, and then that little bit of profit starts earning its own profit. It starts small, but over years and years, that growth curve just goes exponential.
And this is where the two paths really split. A savings account is fantastic for short-term goals, like your emergency fund or saving for a vacation. But the profits often get paid out in tax, which kind of slows down that snowball effect. Mutual funds, though, they're built to automatically reinvest your earnings, putting that compounding power on overdrive. They're built for the long game. Okay, so we've looked at the surprising short-term data, and we understand the long-term theory. So what do you actually do with this information? Let's build a simple framework so you can make a smart decision. At the end of the day, there is no one-size-fits-all answer. No way. The absolute best choice depends completely on you. What are you saving for? How much risk are you cool with? And maybe most importantly, what's your timeline? Are we talking about next year or 10 years from now? So here's a quick checklist to help you think it through. First, get crystal clear on your goal. Saving for a car is totally different than saving for retirement. Second, look at how a fund has performed over years, not just one good month. Third, check the fees. High fees are like a slow leak in your tire. They'll drain your returns. Fourth, do a little research on who's actually managing the fund. And last, make sure their strategy fits your own comfort level with risk.
And you know, the really good news is that getting started with this stuff has never been easier. You can literally set up an account on your phone in minutes. Start with as little as 1,000 rupees and watch your money every single day, all regulated by the SEP. The old barriers are pretty much gone.
So, after all of that, what's the big verdict? The surprising truth isn't that one is just plain better than the other. It's that they're different tools for different jobs. For your short-term cash, a high-yield savings account might actually be the winner. But for building real, long-term wealth, the compounding power of mutual funds is almost impossible to beat.
So, I'll leave you with this one last question to think about. Based on your goals and your timeline, is your money in the right place? Is it really working as hard and as smart as it could be for your future? Something to think about. Thanks for tuning in.